Good morning. Welcome to Stock Market Today. It's Wednesday, October 23rd, 2019, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where you can get daily stock ideas for you to consider in your inbox every trading day before the market opens. So U.S. equities were mostly lower in Tuesday's trading, ending near the worst levels of the day. Treasuries were stronger with the curve flattening. The dollar was weaker versus the yen, but stronger on the euro cross. Gold finished with a small loss, and WTI crude ended up 1.8% after a report that OPEC may consider deeper cuts at their December meeting. At the sector level, that strength in crude helped energy outperform, followed by industrials, utilities, and healthcare. Underperformers were tech, comm services, and consumer discretionary. And as we get to the desk here this morning, futures are down 10 basis points, with earnings getting the bulk of attention here this morning. Treasuries are stronger with the curve steepening. The dollar is mixed against the euro and yen. Sterling weaker, extending its recent pullback. Gold up 60 basis points, and WTI crude is giving a little bit back, down about 90 basis points to get things rolling here on a Wednesday morning. So for the S&P 500, more rejection at the 3,000 level. The waiting really is the hardest part as the index continues to push on that 3,000 mark and get rebuffed at every turn. Key support is at the 200-day moving average, now near 2870. And then obviously the key level in my mind is the August lows near 2820. For now, we're just still in this well-defined trading range, same range we've been in since the highs in July, bouncing back and forth between that range. It is 200 points wide, right? So a breakout you can start to think about where we could go to the upside. Conversely, if we break down below those August lows, you can start to think about where we might go on the downside. Now, the RSI is holding bullish ranges above the 50 level, so that is encouraging, but Chaikin money flow does remain on a bearish reading. So a little bit of a mixed bag from the indicators as the market churns just below all-time highs. And we're going to take a look at how things play out here today. A lot of earnings, tech sectors in focus. Texas Instruments disappointed after the bell last night. So let's hit our market in a minute. What are we writing about in the note today to Chaikin Analytics clients? Well, stocks closed mostly lower as resistance holds for both the SPY and the Qs. It's interesting to note that the Qs have a very similar structure to SPY, pushing on the string near the highs but unable to break through. Sentiment has become less fearful as the market is testing those highs. Texan, as I said, will be a test for the semiconductor group today. Stock trading lower here in the pre-market as they guided well below consensus for the December quarter. We're starting to visualize the growth to value shift, starting to get some play amongst investors. We're going to take a look at what that actually looks like. And as I said, futures do point to a lower open here today. Now, for the power bars, for the major indices, the Dow down 15 basis points yesterday, 4 bulls to 9 bears. S&P 500 down 33 basis points, 112 bulls, 92 bears. NASDAQ was an underperformer on tech weakness. Still skewed in favor of the bulls, though, 22 to 18 bulls to bears for that ratio. Small caps actually finished slightly higher on the day. Rare bout of outperformance relative to what we've seen of late. 647 bulls, 348 bears there. Bonds upticked in a bit of a flight to safety, sending yields lower. And as we said, energy was the leader at the sector level for a second day in a row. We haven't been able to say that in I don't know how long. But the ratio still skewed very much in favor of the bears. 15 bearish stocks for only 1 bullish stock in the energy space. And as we did say, crude is giving some back here this morning. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major markets are mixed. Stock of the day today, CVS Health. Comes to us from the healthcare providers and services industry group, and it was an outperformer yesterday, closing at 66.56, up 1.3% on the day. CVS does have a very bullish Chaikin Power Gauge rating due to attractive financial metrics, very strong earnings performance. There is some weak price volume activity from a trend perspective, but when we roll up the 20 factors, 5 in each of these categories, we come out with that very bullish rating. Very bullish stock, strong trend, strong industry group. This is the type of name we want to consider owning. And what we can see here is a bit of a personality change taking place. Rating turns bullish back in August. Shortly thereafter, the stock begins to outperform the market and continues to do so. But the timing aspect is a bit mixed here. Stock is certainly overbought based on our indicator, and money flow has been mixed of late. What we have here is a stock that is transitioning from a downtrend to flat and now to potentially an uptrend. CVS is an interesting name to me. I do think it looks compelling as a bullish idea. I just don't think the timing is right just yet. I want to see it. I want to see an oversold condition. Ideally, what I'd love to see is the stock hold above this breakout level around $65 and become oversold and with improving money flow. Then to me, it is as a bullish idea. Adding CVS to the bullish watch list here today. Looking at our sector tracker now, the movement of the major sectors over the last 5 days. And as the market's churned here and rates have kind of come in a little bit, we're seeing the bond proxies move to the top of the list. Real estate is an outperformer. Utilities outperformer over the past 5 days. 2 strong days for energy pushes that group into the number 3 slot. Financials, staples, industrials are middle of the road, along with healthcare and discretionary. Materials, comms, and tech are all down over the past 5 days, and the tech pressure is something that we want to be paying attention to, especially here this week. This week is heavy on earnings for technology stocks. As we said, Texas Instruments reported last night and disappointed the street. We're going to hear from other bellwether names in the tech space throughout the week. We'll hear from Microsoft today. We'll hear from Lam Research and Xilinx today. We'll also hear from Tesla and Intel this week. So a key week for technology. See if we can start to get a rebound, or if this is the start of underperformance, which would be concerning given the size of tech within the S&P 500. Now, our industry in focus today is one that we have not been fans of and continue to not be fans of. Pharma services. Over the past 6 months, the group has underperformed the S&P 500 by nearly 10%. And the power bar ratio hints that outperformance is likely to continue, as there are 12 bearish or very bearish stocks in the group for only 6 bullish or very bullish stocks, currently ranked number 16 of 21 subsectors and having moved down 1 slot over the past week. So some of the indicative names there that you want to avoid or potentially look for bearish opportunities. Zogenix, ZGNX, is a very bearish rating. Cara Therapeutics has a very bearish ratings, and Axum Therapeutics, AXSM, also with a very bearish rating in our model at Shaken Analytics. And if we take a look at the group, XPH is the ETF that tracks the pharma services stocks, and we can quickly see that this is a group we want to continue to avoid. Bearish ETF power gauge rating. Now, the trend is strong as it's popped above the long-term trend line, but really that's the only thing that this fund has going for it. We touched on the power bar ratio already. We can see that the fund is an underperformer relative to the S&P 500 or the SPY, so that bearish rating being met with underperformance. So the market and model are in agreement. Currently, the fund is overbought based on our indicator with bearish money flow. So too early to say that the tide is turning for pharma services. Continues to be a group that we would want to avoid based on our process, and all signs point to the likelihood of underperformance continuing. Let's hit what's trending now. Yesterday's S&P 500 gainers and losers, our movers and shakers. Biogen, BIIB, up on earnings and some positive data points around their Alzheimer's drug. Set that stock higher 26% on the day. Harley-Davidson, HOG, up nearly 8% following their earnings report. Didn't see any real news on L Brands. Send that stock higher by 6.8%. CNC, earnings sent that stock higher by 6.5%. And Under Armour rallies nearly 6.5% on news that their CEO will step down at the end of the year. On the loser side of the board, Hasbro's earnings and commentary around tariffs knocked that stock down by 16.75%. Travelers down on earnings and some additions to their reserves. Remember, we started talking yesterday about the shifts taking place in financials and how insurance stocks were starting to show signs of underperformance. Well, there's your Travelers down 8.3% on the day. KMB earnings beat, but it was viewed as low quality. Stock down nearly 7%. Cadence earnings were positive, but sentiment around software remains bearish. Remember, we've been talking about the shift in tech, right? Software been underperforming. Here's Cadence. Puts up some positive earnings, but the stock trades lower by 5.7% on the day. And Mickey D's, McDonald's, earnings out, stock down 5%. Investors starting to doubt what the numbers could be in 2020. So let's look at what we're talking about in the note today. Highlighting this potentially ongoing shift from growth to value. Now, towards the tail end of August, we started to see growth names underperform and value names start to catch a bid. And I wanted to kind of visualize what that looks like. So what I've done is I've taken 6 popular ETFs, 3 for growth and 3 for value in large cap, mid cap, and small cap across both of those investment styles. And what we can see is that the value names are either leading or improving, right? Large cap growth is now leading if we look at a relative rotation and weekly data, while small and mid cap value are in the improving positions, right? So money rotating into the value stocks within the market. And that appears to be coming at the expense of the growth stocks, because of whether we look at small cap growth, large cap growth, or mid-cap growth, we can see that they are now all in a lagging position. And this is relative to the S&P 500. If we think about the S&P 500 being in the crosshairs here, we can see how different areas of the market are performing on a relative basis and how those relative trends have changed over time. It's called a relative rotation graphs. And we can see that value is either leading or improving, while growth is now lagging on a relative basis. And what's interesting to me is that it appears to be early days within that theme, right? We need to start to gauge whether that's likely to continue, but we are seeing now early shifts in investor positioning, favoring value over growth. And what's interesting to me is that really since December 2016, so for nearly 3 years, growth has been a big outperformer relative to value. So if this shift is playing out, I think it could have some important consequences across the investment landscape. So I think it's something that we need to be keeping a very close eye on here going forward. If we're looking at a sign of value leadership, let's take a look at large cap value. I mean, here's IVE, the iShares S&P 500 value ETF. Check out what it did yesterday. It traded at an all-time high, second day in a row. Now, it did pull back with the market throughout the afternoon, but we've had a breakout here, and which has now created a bit of a zone of support around the $120 level for the fund. But what's interesting to me is that as the fund has strengthened and is trading above a rising 200-day moving average, the RSI appears to be shifting towards bullish ranges, right? This last pullback here, which didn't even make it to the 200-day moving average, did not produce an oversold condition for the fund. It actually held within bullish ranges, and the RSI is now starting to move higher. This tells us that there's some momentum behind that trend. And if we look here, it's IVE that's in the leading spot on the relative rotation graph. And another way to see that is to just take a simple ratio of IVE to SPY at the bottom of the chart here, and we can see that a clear downtrend has been broken to the upside. After a short consolidation, IVE is now working higher relative to the S&P 500. So here's another way of looking at that shift towards value names, as large cap value appears to be becoming leadership in the marketplace. And finally, it's Wednesday. On Wednesdays, we do our sentiment work. And what's interesting to me here is that sentiment has become less fearful. 13-day moving average of the CBOE equity put call ratio was starting to get up near levels that warranted a contrarian bullish view, right? These levels towards the 0.75 area tend to mark local lows in the S&P 500, right? We got close to that level and the S&P 500 rallied, but now we're starting to see some less fear in the market, right? We're not at an agreed position, but less fear. Well, what is interesting to me is that the CNN Fear Greed Index has quickly moved to a greed position after being in a position of fear last week. I write about this in my note today. So that's going to wrap it up. Head over to the site, sign up for that email. I'll be back here tomorrow.